I think it's important that that first we start with, before we look at the STO, why we're doing this. So I would start with Bitbond as an entity, because the security token is just something that we've added on very recently. But Bitbond's actually been around. Whoa, we've got a technical glitch here. Let's see if I can. Okay, great. That was the extent of my technical ability. I hope it doesn't get any worse than that. Yeah, so I'm the finance guy. I'm not the tech guy. So that's what, hopefully someone else can help me around here. So Bitbond, we've been around since 2013. We've raised $5 million of equity from mainly venture capital. We're licensed by the German regulator. We're the only fintech licensed by the BaFin. So quite an achievement. I just came on last year, but actually the founder started the process of having Bitbond licensed by the regulator about 3 years prior to the actual licensing, which was the end of 2016. We run independent of banks, so all of our payments of loans have always gone via blockchain, have always been repaid via blockchain, and I'll talk more about that in a bit. Since inception, we've raised, we've lent out or have originated loans in a total of 15 million euros. We have 165,000 registered users. We've originated loans in 80 different markets. And you can see here from the, see if I can, oh yeah, so you can see here from the 27,000 scored applications, we've actually originated 3,200 loans. So the rejection rate's something around 12%. So this is it's a lending platform. The goal was to provide SME lending globally to small businesses that didn't have access to funding. And there's about 50, we estimate it's about 50, well, based on the World Bank data, there's about 50% of SMEs globally that don't have access to the financing they need. So we say about ourselves that we're blockchain powered and BaFin regulated, which is a great combination. Looking at the evolution of Bitbond itself, once again, we're not looking at the STO yet, we're just looking at the organization that stands behind it. We're an operating business. Like I said, we received our BaFin license in 2016. That means that all this time and before that, the German regulator has gotten familiar with our operations, has gotten familiar with us as an organization. We added on institutional investors as an organization, enhanced our cash flow modeling process, which is a really exciting system. It's something, I was in banking for 14 years, and I have to say I haven't seen systems like this outside of banking. It's very much cash flow based, highly automated. We work very closely with the University of Potsdam to insert machine learning into that modeling process. We're doing constant back testing. It's really a beautiful thing. So I encourage you to come by to Berlin and take a look at what we're putting together there. So we're right now here. This is an exciting opportunity for us because we started out as a standard marketplace lending platform. Who was financing the loans? The crowd was, the marketplace. Individuals putting 500, 1,000 euros in there. Little mini syndicates were being formed over the course of 2 or 3 weeks, and borrowers were being lent money. Then right after getting the BaFin licensing, we started bringing in institutional funds. That was great for the borrowers because they didn't have to wait for these mini syndicates to be formed. The financing was there available, but the institutional investors always had their own requirements. We score all of our applicants on a range from A to F. So very often an institutional investor would come in and say, I only want A to F, I only want Western European loans, which limits our business and our ability to originate to our full capacity. So this is where we are now. This is the total origination that we've done. Most of it has been since we brought on institutional money, but we want to go beyond that. We want to diversify our financing as a company. When I say diversifying our financing as a company, it's not Bitbond's financing. It's the ability to make and originate more loans. So it's, let's see if this goes. No? Okay. Oh yeah, there we are. So before I talk about the STO, I would just want to say a couple more words about the typical borrower that we're originating loans for here. So these are working capital loans. They go up to a maximum of 50,000 euros. Our average loan size is 12,000 euros per borrower. These are small businesses. We originate actively. I would say 80% of origination is done in Western Europe. We also have a sizable operation through a partner we have in Kenya called Jumia, which is an e-commerce platform. 60% of our small businesses are e-commerce retailers, Amazon resellers. So when going through the credit process, we analyze the business of each of the borrowers. When the borrower comes online to start the application process, at that point we're already asking for them to link us to all of their business bank accounts. So we're scraping the data via APIs with hundreds of different banks that we have interfaces with. If it's an e-commerce seller, we also take the data from their Amazon or from their eBay selling account. We take the revenue data, we take all the information coming from the bank accounts, and we plug that into our credit model. We have a classification model where we can, in 8 different languages, search for chargebacks or other red flags that might be coming up. And in the end, we have a cash flow based result, which is a system of KPIs and ratios where we can define what's the debt capacity of a borrower, in our opinion, what's their real liquidity, what's their debt service coverage ratio. So all the different ratios you would expect to see in the banking world. And afterwards, if anyone would like to go through what some of these terms are, and I don't know how in-depth your background is in credit, but I'm happy to take people through what we look at when we're analyzing credit. So as I mentioned, these are smaller businesses that have very little access to lending opportunities. It is a high yield business. It's also a high risk business. So the average interest rate is between 23 and 25%. We do suffer defaults, obviously. These are small businesses, but they have to be profitable. They have to have a profitable track record that we can quantify. And as I mentioned earlier, our credit model is being, we're working very closely with the University of Potsdam in order to insert machine learning. But before we get to that point, to be completely AI-based credit analysis, we first have to ensure that we actually are able to back test all of our data and refine our ratios and make sure we get to the point where we're like, I see there's a question in the audience.
Quick question. Is 25% the ratio of a loan shark towards those businesses?
Well, you need to ask the businesses. These are, once again, these are small businesses that aren't getting access to financing. If you're a retail seller and you take out a loan of, say, 23%, it's an amortizing loan. So you're not paying an interest rate of 23% because you're amortizing the loan. It's coming down like this, right? So it's, in the end of the day, if you want to churn your inventory to create more revenue, it's a cost of doing business. And in that 12 months when that loan is outstanding, if you're able to churn your inventory 2 or 3 times to produce 2 or 3 times revenue than you normally would have if you didn't have that financing, then it's a cost of doing business that most of our small business partners would be happy to pay. So.
Right, which brings the question: at which percentage do you become not profitable anymore? How low can you go on that when competition forces
Well, yeah, could you repeat the question?
At what percentage can you loan and still remain profitable?
Well, it has a lot of factors to consider there. So obviously, to remain profitable, you have to make sure your interest rates are higher than your default rates. We're doing our best to predict upcoming credit cycles. So we all know that we're due for a credit cycle. It could be tomorrow, could be in the next 24 months, could be 3 years. We're in uncharted territory right now. So we have to always, the basic answer is we have to ensure that that the interest rates are always higher than our default rates. Not sure what that. Okay. I hope he didn't take it into the restroom because.
What percentage of loans do you accept?
No, it works.
Okay. What percentage of the people who basically ask a loan from you can you basically give a loan at the moment?
It's between we accept between 8 and 15% of loans that have been applied for.
Okay.
So once again, these have to be profitable businesses themselves with a track record.
And what's your profit percentage on it? So of the 20%, how much is your net profit at the end? So far?
Yeah. Basically all the profits we've been making, we've been reinvesting into the company so far. So, and the Bitbond itself, it's actually an important point to clarify. Bitbond itself, we are making revenues from the origination fees that we're charging to the borrowers. So the actual financing, thanks. The actual financing is the benefits of the financing are going to the investor. So if you're an individual, if you're an institutional, if you're an investor in the STO, then you're reaping the benefits of the interest rate that's coming off of these loans. So on to the STO. I hope. Okay, that's some World Bank data that I mentioned earlier. Here's a video I think I'll play at the end, assuming we have time. So what are the terms we're offering? It's 4% annual coupon. Profit-based upside means 60% of the profits that the issuing vehicle makes, 60% goes to the token holders. It's a 10-year maturity. We do have a series of discounts, which I'll talk about in a minute. It's issued via the Stellar blockchain, and the minimum investment is €1. So it is a BaFin-approved prospectus. It has been. It does comply with the European Prospectus Directive. So it is a retail product. So individuals can invest as low as €1. Of course, it's also open to institutional investors as well. This is how the token fits into our overall business plan. So, as I mentioned previously, so this is the borrower. This is Bitbond, the platform that's originating loans for the borrower, and this is the new investor, which is the issuing vehicle for the token. So, just to be clear, the token is a tokenized bond. It's a piece of debt, but instead of trading it traditionally in capital markets, like you would a corporate bond, where it would be transferable via the Stellar blockchain. Yeah, these are not bearer bonds. There is no piece of paper that refers to this instrument. It's under German law. I'm going to try to get away from the speaker. Under German law, it's called a Namens. It's not. Okay, I just got away from the speaker, and it's getting worse. So I'm going to go back to where I was. I don't know if I can trust you anymore. In German, it's not a registered. In English, we would call it a registered bond. In German, they call it a Namensschuldverschreibung, which this is not. There is no piece of paper sitting with a custodial anywhere. Okay. Yep. You can call it a bearer bond. That's not how we would traditionally define a bearer bond legally, but I'm happy to go with that. The important thing is I think we both agree on the fact that this asset can be transferred bilaterally. And in the Stellar blockchain, there's actually an exchange mechanism built in there, right? So, yeah, there's a question in the back.
Yeah, hi. Excuse me, but I don't really understand the difference between your platform and a regular bank. Could you elaborate on it?
Yeah. So a bank takes actual deposits. Here, we're two separate entities. One is an operating entity, which makes lending possible for investors to participate as well as borrowers. So we're basically intermediating business. The issuing vehicle is essentially a standalone investor. It's taking funds from all of you, putting them together, and investing in loans that are being originated on the platform. A bank, the big difference is the bank takes actual deposits.
But isn't you taking or giving out these tokens the same as taking deposits as banks do?
No, I would say it's not. Bank deposits are insured by various entities. This is an investment opportunity which, although it is highly liquid, we expect it to be highly liquid due to its transferable nature on the blockchain. I would say it's very different than a standard deposit of you taking money to your bank and leaving it there. Yep, another question.
Are the bonds freely tradable once they're out there?
Yeah, so the subscription period begins on the 10th of March. There is a series of, oh no, let me see if I can find it here. Okay, it's in the video. I'm going to show you that in a second. It starts the 10th of March. Subscription period goes until the 11th of March, goes until the 10th of May, so 8 weeks. During that period, there's no trading. And then after the 10th of May, when the subscription period closes, everyone has delivered their tokens, and then you're free to do with your token as you please.
Sorry, the token represents an underlying loan, as a part of an underlying loan.
It represents it's an issuance from a vehicle, and that vehicle invests in small business loans. It pays a quarterly coupon of 1% per quarter. There's nothing akin to accrued interest. In a typical bond, if you trade it in the middle of an interest payment period, then there's a special calculation you apply to it. It's called accrued interest. This bond, if you own the bond on the cutoff date, you get paid the 1% coupon. If you sell it the day before, you don't get the 1% coupon. So it's 4 times a year, 1%. That's fixed. And then the 60% profitability is paid once the annual accounts are finalized. The accounts are made public. The transfers, the amount of tokens it's all public information that we make available on the website bitbondsto.com. And as long as you're not a U.S. or Canadian citizen, you're welcome to invest. Yep, thanks. Yes, go ahead. Just 1 second. The cube is coming.
Yeah. What happens when there's a loss? So, like, a company is not able to pay back the loan.
Sure.
Is the token then being removed from? What's happening with the token and what's?
Right. So the typical portfolio should be giving off an interest rate of, say, around, let's say, 20%, just to be conservative. So, let's say if there's 10% losses, so you still have a 10% buffer to compensate for that loss. So of that 10% that's left over, 4% would be taken out as your fixed coupon. The other 6% would then remain as profitability of the company. So losses will happen. Like I said, it is a high yield business. These are small businesses. Some of them do go into default. That's our experience as well. But the buffer, the amount of additional spread within the construct will be able to compensate for that. Yes, go ahead.
And what do you do with businesses who are in default? Hey, in a normal business,
Yeah.
they will be bankrupt or whatever
Sure.
by legal matter.
Sure.
What are you doing with these people?
Yeah, so part of Bitbond's normal operations, we do the credit underwriting, we do the payment flows, and we also do all the workouts. So for European borrowers that default, we have different legal mechanisms that we can go through, all the way up to account seizures, which are a unified law under EU regulation now that we can even apply for accounts to be seized if borrowers are not repaying their loans. But of course, first we start with local courts, we start with dunning letters, and that's something that's the service that Bitbond provides to all of the investors when a borrower defaults.
So the 4% is paid quarterly? Is that
That's correct, yeah.
And the 60% of profit, that's paid quarterly as well?
No,
or
that's
is it
paid
annual
annually because there has to be,
on the finalized accounts?
exactly, yeah.
So one could actually expect the 4% to behave like a dividend because it's going to be built into the token and then paid out. Token value will drop by that amount. Is that correct? You'll see that sawtooth pattern in trading value?
I can't predict that, but it's structured to be paid as a fixed coupon.
Okay.
Okay. I show you guys the video. It's only about a minute and a half. Just a second.
Until it starts working.
Yeah.
So how do I get?
Oh wait, we need sound. How do I get sound here? Just a second. Aha. There we go. There we go. Is that too loud?
In the Bitbond token. The Bitbond token is a security token with a prospectus that is approved by the German regulator BaFin. Investors participate in the profits of growing online businesses and the success of Bitbond at the same time. As a token holder, you will receive 4% interest per year plus 60% of the profits of our investments, all while you support the financial inclusion of entrepreneurs. Over 120 million small and medium-sized enterprises around the world increasingly sell their goods and services online. However, they face one big growth obstacle: insufficient access to credit. That's because banks simply haven't built the technology to serve these businesses. Bitbond leverages blockchain technology to provide business financing worldwide. By replacing the inefficient SWIFT system with blockchain-powered payments, Bitbond reaches every business owner globally, from a freelancer in the UK, to an online seller in Kenya, to a restaurant in Singapore. Bitbond is a regulated financial institution. This makes it the first blockchain company with a license from the German financial regulator BaFin. Innovative data sources like e-commerce sales and bank account transactions fuel Bitbond's machine learning-enabled credit scoring technology. The platform is live since 2013 and has over 150,000 users. With your help, Bitbond aims to become the world's leading business lender. Are you ready to get ahead of the game? Do you want to profit from Bitbond's revolutionary lending platform? Join the official crowd sale and secure yourself one of the world's most innovative tokens. Bitbond.
So, any other questions?
Sure.
How are you geographically loading out? Are you Africa, Asia?
Yeah. So we're about 80% Western Europe. One of our largest markets outside of Europe is the U.S. and Kenya. Actually, we're looking to expand greater into sub-Saharan Africa, but obviously we need local partners that we work with, and we have a very good rapport with Jumia, which is e-commerce platform in Kenya, kind of like the African Amazon, if you will. And with local partners like that, we're able to go into all a variety of jurisdictions.
Yes.
We have one more question. We have a lot of speakers still to go, right? So
Okay.
maybe the last question.
Yep.
And then in the break, you're
Yeah, happy to.
answer our questions, right?
If you're doing the credit score, what do you do with the data that you get to do the credit score?
Yeah, so we're under BaFin regulation, under the German regulators' requirements for KYC as well as anti-money laundering. We also have to abide by the GDPR requirements of data protection, if I said that right. Sorry?
So you are not saving the data?
We're not sharing the data.
No saving the data.
Yeah. Yeah. Yep.
Okay, thanks a lot, Martin, for sharing.
Thank you.